Good morning, everyone. Today, I will begin our group presentation with a brief introduction to our valuation studies on Apple Incorporations. Our presentation will cover company's overview, why choose Apple Incorporation as our presentation title, data and methodology, valuation component, pro forma financial statement, sensitivity analysis, discussion and interpretations, along with conclusion and recommendation. Apple was founded in 1977 in Cupertino, USA, and is one of the world's most influential technological companies, known for products like iPad, Mac, iPhone, and services including iCloud and Apple Music. The purpose of this project, as part of our financial modeling module, is to analyze financial performance, forecast its future cash flows, and estimate its intrinsic value using valuation tools learned in this course. Why choose Apple Incorporation as our presentation is because it is globally recognized brand with stable revenues, strong cash flows, and diversified product and service portfolio. The company's financial statements are easily accessible and detailed, making it suitable for financial modeling and valuation analysis. Apple also provides a practical example of how valuation techniques can be applied to a large technology firm, which helps us relate theoretical concept to the real world company. And then we have next is data collection. For our data collection, we use publicly available information from Apple's annual report, financial statement, and trusted financial databases. We conclude 5 years of historical data including revenue, expenses, net income, balance sheet figures, and cash flows. These data form the basis for forecasting, ratio analysis, and the valuation model that will be explained by the next presenter. Thank you.
Now I will continue with the presentation. Valuation input and valuation result. This valuation implies the discounted cash flow model to estimate the intrinsic value of Apple Incorporation. The projected free cash flow to the firm amounts to $70,250.81 million, indicating robust future cash generating capacity. A weighted average cost of capital of 3.55% was applied, reflecting Apple's ability to raise capital at relatively low cost. Additionally, a long-term growth rate of 4.26% was assumed, consistent with the company's historical performance and expected market sustainability. Based on this input, the firm's terminal value is calculated at $2,060,843.91 million, representing Apple's value beyond the explicit forecast period. After discounting all future cash flows, the estimation yields an enterprise value of $2,057,953 million, which after adjusting for debt and capacity results in an equity value of $3,150,272 million. Consequently, the intrinsic value per share is determined to be $204.44. Comparatively, the current market price stands at $222.86, indicating that Apple stock is overvalued by approximately $18 per share. This implies that the market may be incorporating optimistic expectations that exceed the company's intrinsic fundamental. Therefore, while Apple maintains strong financial prospects, the stock price suggests caution from an investment standpoint. Next, the pro forma income statement. The projected income statement indicates steady growth in Apple's financial performance over the forecast period. The total net sales increases consistently from $274,515 million in 2020 to $606,011 million in 2029, supported by an average annual growth rate of 8.02%, reflecting sustained demand for Apple's products and services. Gross margin levels also rise, maintaining around 46.21% in 2024, signaling improved production efficiency and strong pricing power. Operating expenses follow a controlled growth pattern with a reduction in growth rate after 2024, implying enhanced operational efficiency. As a result, Apple initially demonstrated strong profitability, with net income increasing significantly from $55,256 million in 2019 to $99,803 million in 2022, although there is a slight decline to $93,736 million in 2024. A notable jump to 128,421 million in 2025 highlights short-term growth potential. However, the projection also indicates sharp downturn in profitability starting in 2026, with net income eventually turning negative by 2028 and 2029, suggesting potential financial risks or operational challenges in the long term. Worsening in 2029, suggesting serious financial challenges or operational issues. Now, coming to a pro forma balance sheet, the balance sheet shows projected assets, liability, and equity over the same forecast period. The key highlights include assets grow over time from 148,749 million in 2022 to 17,259 million in 2029. This shows that the company is expected to expand, likely through investment in both current and non-current assets. Liabilities, total liability including both current and non-current liability also rise. The growth is projected to be consistent, with the balance between debt and liability increasing in line with asset growth. Shareholders' equity grew by 75%, reflecting strong profitability and strong capital base. This suggests improved financial stability and flexibility. However, the impact on the shareholder depends on the company's strategy and market conditions.
So now I'll be explaining about the free cash flow forecast. So the free cash flow forecast, so for Apple, it demonstrates a consistent upward trajectory over the projected 5-year period, indicating not only growth but stability in the company's ability to generate cash from its core operations. So this sustained increase highlights Apple's strong operational performance, supported by efficient cost management, expanding product demand, and a growing service segment that contributes recurring the revenue. And the rising level of the free cash flow is particularly significant because it reflects the Apple's ability to fund its own investment without relying heavily on the external financing. So with higher cash availability, Apple is positioned to reinvest in innovation, research and development, and the market expansion, strengthening its competitive advantage in a rapidly evolving technology industry. And so moreover, strong cash flow enhance the company's ability to deliver the value to its shareholders through the dividends, the shares, the share buybacks, and the debt reduction, improving the overall investor confidence. And this financial flexibility, it also provides resilience against the potential economic or the market uncertainties. So in summary, the projected upward trend in the free cash flow, it illustrates the Apple's solid financial outlook, their operational efficiency, and long-term sustainability, reinforcing its position as a financially strong and strategically capable global leader. And the next one, it is the sensitivity analysis. So this sensitivity analysis, it shows how the intrinsic value of the company changes when both the growth rate and the weighted average cost of capital, WACC, it vary. So as seen in the table, when WACC increases, the firm's valuation it decreases, reflecting that the higher discount rates reduce the present value. Similarly, when the growth rate increases, the valuation rises, indicating that higher expected future growth, it boosts the intrinsic value. And the non-value, it appears where the unrealistic or the mathematically invalid conditions occur. So for example, when growth rate exceeds WACC, making the discounted cash flow model unreliable. So overall, the results highlight that the company's value is highly sensitive to both the growth and discount rate assumptions, reinforcing the importance of using the realistic estimates in valuation.
Now that we have looked at Apple's overall performance, let's move on to interpreting what these results actually mean for investors. It can be seen that Apple have strong cash flow and capital efficiency. Apple continues to generate very strong cash flows, which gives the company a lot of flexibility for reinvestments, debt repayment, and shareholder returns. Their low cost of capital also means they can fund projects and expansion very efficiently, which adds to their long-term value. However, When we compare the intrinsic value to the current market price, the stock appears to be overpriced. This suggests that the market may be expecting more growth than what the fundamentals currently support. One concern is the projected decline in Apple's net income starting from 2026. This decline can indicate potential risks such as increasing costs, market saturation, or competitive pressure. Because of these signals, it becomes very important for investors to closely monitor Apple's profitability trends in the coming years. Small shift in profitability could have a large impact on valuations. Now, based on these interpretations, we can now move on to conclusions and see what this for overall for Apple. Apple remains financially strong but overvalued. Apple is still a very strong company financially, with solid cash flows and strong market presence. However, based on the valuation analysis, the stock appears to be priced higher than its intrinsic value. This means the market may be expecting more growth than what the fundamentals currently support. This overvaluation naturally leads to the next point in investors should remain cautious. Because the stock is trading above its fair value, investors need to be cautious. If Apple does not deliver the level of growth that the market expects, the stock price may correct downward. And these cautions become even more important when we look at the projected decline in profitability beyond 2026. Another concern is the projected decline in Apple's net income starting from 2026. This downward trend could affect future performance, so it is important to carefully monitor Apple's profitability in the long term. Given this potential decline, Apple should take proactive steps to maintain earnings, focusing on cost control and developing new revenue streams. To manage these risks, Apple should strengthen cost control measures and continue developing new revenue streams. This will help support long-term earnings and reduce the impact of declining profitability.
Thank you and currency!